Since the 2022 Legoland crisis, real estate project finance has remained a risk to the Korean economy. Developers often contribute only 3% of total costs as equity, relying on guarantees from construction companies to secure the remainder through bank loans. When the real estate market weakens, it can trigger a domino effect across developers, contractors, and lenders. The government has responded by announcing a mid to long-term target to raise PF equity ratios to around 20%. But does expanding equity actually reduce systemic risk? KDI analyzed approximately 800 projects in Korea and found that, at a 20% equity ratio, debt and debt service decline, consequently reducing presale risk. An analysis of U.S. apartment PF also shows that, as loan-to-value rises, the likelihood of distress within 3 years of groundbreaking increases, while the probability of successful post-default restructuring falls. Even when projects reach completion, post-completion refinancing becomes less likely. The pattern is clear. Lower equity and higher debt are associated with higher risk. Equity expansion also brings another benefit: lower total project costs. When equity reaches 20%, construction costs drop by about 6.4%. This appears to be because larger equity positions reduce reliance on external guarantees. As that reliance declines, guarantee premiums paid to obtain guarantees from high credit contractors fall. With less borrowing, financing costs, interest and fees fall by about 12.6%. Other charges and registration fees, which scale with risk and construction costs, also fall. However, raising equity capital presents significant challenges. As equity requirements rise, development activity may slow. Therefore, future PF policy should combine equity expansion requirements with supporting incentives. KDI reviewed the government's PF measures announced in November 2024 and analyzed how to strengthen them. First, when the government implements its planned aggregate lending limits, these limits should target exclusively low-equity PF loans, ensuring that prudent projects with higher equity ratios retain access to standard financing channels. It is also crucial to define clearly what counts as equity. While equity traditionally encompasses only common shares, preferred shares should be recognized. Preferred shares do not grant control, but confer priority dividends. They also allow investors to receive dividend income during the project period, encouraging greater equity participation. Lastly, for project REITs, when land is contributed as an in-kind investment, capital gains tax deferral is now permitted from the contribution date until profit realization, under a temporary 3-year provision. Given that PF projects typically extend over multiple years, this deferral should become permanent to alleviate uncertainty from potential policy changes. Some are concerned that the deferral might reduce government revenue, but taxing at profit realization actually captures development gains and can increase total revenue.
한 가지 방안을 추가로 제안하자면, 대규모 사업에서는 시행사가 지분 투자자와 함께 PFV라는 특수 목적법인, 일종의 페이퍼 컴퍼니를 설립해서 PF 대출을 받는 경우가 많습니다. 그러나 PFV는 비슷한 성격의 프로젝트 리츠와는 달리 건전성 규제와 감독이 없어서 여전히 과도한 위험 추구의 수단으로 이용되고 있습니다. 따라서 PFV에 대해서도 프로젝트 리츠 수준의 건전성 규제와 감독을 도입해 규제 차익을 줄이는 방향으로 개선해야 합니다.
Real estate PF has long been flagged for structural vulnerabilities. To reduce risks without unduly constraining development, balanced policy design and careful implementation are more important than ever.